I'm Guy Keller from Tribeca Investment Partners. I'm part of the global natural resources business. I also run our nuclear energy opportunity strategy that's been going for just shy of 6 years, where we're very focused on the uranium mining part of the nuclear fuel cycle, but also look through the whole cycle.
Guy, good to see you. Been a while. Hope you're okay. Over there in Oz. I put on a special party shirt for you because I kind of feel that it might be time. This year is the year. How long have we been saying that? It feels like we've been saying it for 4 years.
I thought you'd come from a paintball competition.
I won, by the way. You need to know I won. Right. I want to talk about obviously the mega thematic, which is obviously the energy transition and the role that nuclear has to play in that. You run a fund which is called what?
Nuclear energy opportunity.
Wow. Well, there we go.
NEO for sure.
Here's the thing I want to try and understand is we've been talking about the geopolitics. We've been talking about which companies are going to make it, which companies are going to win. The kind of the price term contracts. We talk about lots of things. What's actually important to look at? Because right now it feels like in junior equities, it feels pretty tough. People are a little bit nervous, less disposable income, not quite sure where to focus. What do you, as a fund manager, look at, and what gives you comfort you've made the right choices?
Well, you've got to come back to the basic fundamentals. With the existing fleet, there's not being enough uranium mined to service those. And then you've got the biggest reactor build program in decades. There's not going to be enough uranium mined, to fulfill that obligation as well. And price is one thing, but there's permitting, there's a whole bunch of other things that need to happen. And we're not even there on price for the majority of that. So, let's just strip it down to basics. That's where you start.
Okay, so we're talking about supply-demand fundamentals. Inventory levels today suggest that people should be stocking up, but they're not. So how do we read it?
Well, it comes down to how you look at it. When you look at, obviously, as many of your listeners are aware, if they're tuning in regularly to your programs, uranium's beginning of the nuclear fuel cycle, and the pricing through that fuel cycle is at all-time highs: conversion, enrichment, SWU pricing, and that is the processing of that uranium. So that's telling you that there's activity happening. We're seeing 115 odd million pounds contracted last year. I think the number more recently for this year to date is 107 million pounds. Somebody said this morning that they could see it going to 200. But as Grant Isaac at Cameco always says, 115 million pounds is great, but it's still below replacement value. Utilities are consuming, depending on how you look at it, let's say 170 to 180 million pounds a year. They're not replacing that, and they haven't done that for a decade. So I'd actually say that, it's the busiest we've seen on a contracting basis since the last cycle. It's just not that observable for tourists sort of peeking into the sector.
Right, but okay, so it's as simple as that, supply demand. Okay, and I hear what you're saying. We've been talking about our weekly energy show for the last 3 years in terms of how this would play out, but this is accretive at best. Can you sort of understand why people looking in go, I just can't trust this uranium play any longer. We're up, we're down. No one seems to know what's going on. I'm not quite sure where the bottom is. I'm not quite sure how price moves and what, quite frankly, I should be looking at. It's so opaque.
Look, we started talking 6-7 years ago, and we entered the space at a time where you were sort of getting interested as well, and we thought we were timing a few of the false starts that we'd seen in the years leading up to that. And since then, we've seen a few other false starts. But I think the difference is every time you get those moves, it's building more of the thesis. There's more eyeballs on it. There's more people that understand it the next time it moves. But, and yes, it's opaque, but lithium's opaque as well. Like, who can honestly actually tell you where a lithium price is? People point to a whole bunch of different benchmarks, and it tends to be whichever one suits their narrative. The difference is the broking community has a huge amount of deal flow for lithium. So investors are seeing lithium deals on, not recently, but certainly in the lead up to. As an institution, you'd be getting half a dozen deals across your desk per day or per week. Analysts are writing notes on it. So, but you go and ask somebody, where's the lithium price right now? They'll sort of try to scramble to find one. So commodities, for the most part, are opaque markets, with the exception of your macro commodities, obviously, where you can see a copper price or a gold price or an oil price anywhere.
Right. Okay. But I think I always feel like the mining sector is, so small, right? It's a tiny, tiny little universe we all operate in, and we're not as important as we think, because there are other verticals which the banks are paying attention to, and we have seen Sput obviously come in. We've obviously there's Yellow Cake in the UK. You've got a new group out of Switzerland as well. Obviously your group, but it's like it's a small amount of people paying attention to this space. Is size the problem? People can't deploy the capital that they want, or does it come back to the fact that people just don't understand the metrics, or which metrics to believe, or how this industry plays out over the next hopefully 24 months?
Look, size absolutely is the problem for the sector when you look at institutional money and pension fund and superannuation funds here in Australia. The sector, I always use the Australian example, the whole investable universe of uranium, including Cameco and the free float of Kazatomprom, the market capitalisation of that global sector fits inside the market capitalisation of Fortescue Metals. Yet it's a sector that's providing the raw material for 10% of the world's electricity. So there's a massive disconnect from what it does and the investable opportunity. And when you look at more recently, you look at the outperformance of Cameco, because money has gone to the producing liquid stock in order to have some exposure there in times where there's a bit of macro uncertainty. But it's a pretty small to be able to have one stock that some of these guys can invest in. And so then you're at the mercy of retail investors. And I often say this is a grown-up thesis being thrown around a school play yard because of that disconnect as to the knowledge of understanding you need for the sector versus the investable opportunity.
Okay, well let's stick with this kind of supply demand a bit at the moment, because if that's the important bit of this in terms of what supply is coming online and what the demand numbers are. I'm not quite sure who to believe on the demand numbers, because they're such a wide range being proffered up. Look, everyone's got a vested interest in presenting different sorts of numbers, right? So if you as a fund manager looking at on the supply side, obviously you're looking at all of the companies, you're evaluating all the companies, you're trying to work out who's real on a fundamentals basis, who's real and what's a kind of, I guess, market play, momentum play. You probably invest in the former because you need this thing to kind of play out. You can't rely on momentum as an investment strategy. So what do you see in terms of supply coming and those companies' ability to actually get into production anytime soon? And I say that in the backdrop of things like the recent conference in DC, where you've kind of got politicians like very, very much engaged now in this energy transition solution, even the EV revolution, because those cars need to be powered with something. How do you look at this kind of supply side of things?
Look, there's obviously there's a handful of companies that have funded to production restarts at the moment, right? So they've gone out, they've ripped the Band-Aid off, they've raised some money, and they're coming. So when I look at those companies, and we're fairly heavily weighted at that end, we're into either producing companies or those funded to productions. Because when I look at those restart projects, like no mining project is ever going to be built on time or on budget, and restart projects are never going to go smoothly. But when I look at the ones that are in the process of coming to market now, the sunk capex is there. Yes, they've changed some of the process of what they're doing. So they will come to market. There's plenty of people who sit there and go, oh, see, the moment things pop up, all of this supply is coming on. The question I ask everybody there is, well, once the handful that are currently moving make that decision and successfully start moving to the market, you still haven't solved the supply deficit for a start. And what's next? I mean, you talk about Washington, IRA and US government support, and yes, it's both sides of the fence. And there's probably a dozen companies that are telling you that they're going to be able to benefit from that with US production. But the reality is, in the next 12 to 24 months, there's probably 2 or 3 of them that are going to be able to deliver the pounds that they say they're going to, because they're good assets. They've got a good process that's worked in the past or is easily replicable, and they've got good people and good access to capital to be able to do that. And they probably already either got some sort of a contract or indication to show that there's demand for their product. So, it comes down to really separating the wheat from the chaff. And, again, we have the beauty and the advantage of cycles. In the last cycle, there was dozens of projects that were going to come to market. And even before Fukushima, only a handful of those were able to actually deliver. So the supply is going to be a really, really interesting one to watch. And whilst, a rising tide will float all boats, there's going to be a few that stand out, well above the rest of the peer group and actually start delivering pounds. And what does that do? It then allows institutional investors to see a pathway to production and cash flow, which means that the analyst that's gone out and worked really, really hard to get CFA and a few dashes after their name can actually go and start modeling some of these companies and present that to comparable universe of their portfolio manager, make a decision.
Right. Okay. Yeah. Yeah. So let's not talk about analysts. I used to be one. I have a very low opinion of them. Generally, they're incentivized in different ways, right? Okay. So then this comes back to this here, who to believe. And I agree with you on the supply side. For me, else it's kind of better to kind of focus on the developers and producers, because at least it's been heavily de-risked. But if I do look at the supply side, even if everyone comes on tap, it doesn't feel like it's enough. Or is it? Because come back to the demand numbers, is like I'm not quite sure what to believe and at what pace this thing's going to move. Like I said, it's opaque. So how are you reading the demand side? Is there kind of demand destruction, or should we be more optimistic? I mean, how do you view it?
The beauty about the demand side in the nuclear sector compared to demand side of other commodities where macro factors are at play. For example, copper. I mean, how do you truly model how many air conditioning units are going to be built and consumed per year, and how to a reactor runs until it doesn't, and it it may come down for maintenance and things like that. But in a normal operating, we've got enough data to be able to look at a reactor and say that's going to be operational X number of days, so it's going to consume roughly this many pounds, and it's on that recycling refueling process. So it's actually quite, and it doesn't move fast, So even if a reactor says we're going to shut down, it's not tomorrow; it's in 3 or 5 years' time, or maybe longer. And we naturally assumed that the nuclear have countries were starting to roll off some of their reactors. They're coming to the end of their approved lives, not necessarily their ability to operate, but their approvals. And there was political decisions around that. That's now gone back to flat, right? So that fall off in demand that you may have seen just naturally occurring has now gone to flat. You then throw in that 50-odd reactor build, 25 million odd pounds. That's this MacArthur River running at capacity to fulfill that, or next gen's Arrow come into production, and you say great, but then people sort of forget. They say, oh well, 50 reactors and then we're done. It's like it's not going to just stop there. Those are 50 reactors being built that will connect to the grid between tomorrow and 2026. The countries that are building these things aren't stopping there. So I actually look at that demand equation and say, yes, you can tie yourself in knots around looking at annual demand each year because of refueling priorities, but the demand's not going down. In fact, it's going up. And if you've got a supply deficit now on current demand, then you're going to have a supply deficit on future demand because it's going the wrong way for you on that equation.
But Yeah, we're seeing that as well in the EV thematic too. Like I could reference this conference in DC last week because one of the guys who came on the show and said, like, I spoke to I think it was three of the big US automotive manufacturer CEOs. Right, one of those CEOs said, "Oh yeah, we're all in. We're absolutely all in on the electric thematic. IRA's helped us. The Inflation Reduction Act has helped us. Something like 137 billion bucks allocated to that for industry and automotive manufacturers so far. None for miners. Well, sorry, a little bit, but that's energy security elsewhere. And you go, okay, that's cool. So what are you looking for? We're looking for well, obviously lithium, copper, et cetera, et cetera. How much lithium do you need? He gave a number to the guy I spoke to of between 60 and 100% of today's lithium production, global lithium production. One automotive company. Now, either the guy got his numbers wrong, or he doesn't quite understand how mining works, which is obviously problematic. At the same time, you've got fantastic. Joe Manchin was that he gave a great talk. Apparently, talking we're going to support this industry, we're going to support this sector. We're all in on the green. And you go, but you're not helping miners. You're not helping miners because the permitting and licensing is problematic. You need to kind of get out of your own way. You got to maybe think about things other than tax credits, because that's after the event, and incentivize or even fund mining companies in different ways, because industry doesn't seem to know. We're talking about supply-demand gaps, right? Supply-demand gaps in EV, to me, was shocking, because he then spoke to another two automotive CEOs who pretty much said the same thing. So you got between three companies, it's 2 to 3 times the world's current production of lithium. Something's got to give, right? So in the same way for uranium, do you think the politicians are talking a good game without necessarily understanding the kind of potential problem they're causing during the supply-demand fundamentals? It seems to me, and utility buyers not really moving because they're watching their own dollars in their own bank account, make sure they're buying the cheapest possible and at the last possible minute. And it just feels very precarious. Is it likely to fall over as it is likely to succeed, or is the train left the station and these infrastructure bills will kind of drive a solution?
Yeah, I mean, it's a really good question. I don't think politicians do factor that in. I mean, across anything. I mean, the perfect example is, Newsom with Diablo Canyon turning around and doing a complete backflip on that, and suddenly the fuel buyer at Diablo Canyon's sitting there going, holy moly, I've got to go and find 6.1 million pounds of uranium equivalent now to keep this thing running, because the governor's not only talking about the lights not going off, but he's now talking about desalination plants and hydrogen industries around my reactor that I don't have fuel for. The City of London banning diesel vehicles by whatever year that is. Were they considering how much lithium was required to replace those vehicles with electric vehicles? No. And that's the problem you're seeing everywhere at the moment. It's these political decisions are being made. The US is a really interesting example because they are playing a much bigger global game around energy security and energy technology ownership as well. So it doesn't surprise me that they're pushing, to build reactors, to push Westinghouse technology out to the rest of the world, to push Cameco out as a proxy for them for fuel contracts, HALEU tenders. It doesn't surprise me that they're trying to win that technology race. Will the uranium come? Probably eventually. I mean, they've proven that they'll buy a little bit here and there just to keep people happy. But yeah, I think they're probably more aware of it, the US. But it's not just uranium, to your point. It's everything, and we probably will have to have a come to Jesus moment eventually, where we sort of turn around and say, you can't go from 100 units of carbon to 0 tomorrow. You just can't do that. There has to be a plan and a transition to be able to properly manage that. But does that mean that demand for these raw materials craters? No, it probably just means that a more realistic ability to mine is put in place. I mean, 2016, who got lithium demand right then? No one. And everyone was wrong because they were way too low, because nobody saw that there was going to be all these governments turn around and ban vehicles, and that you see these gigafactories just explode over the world because, sorry, not explode, but, be building everywhere around the world because governments are saying, wow, this is a great technology play for us, and we can decarbonize. So they'll fall into place eventually.
Well, yeah, let's not talk about politics. I'll be here for 4 hours. Stupidity of decision making. Okay, but let's talk about some of the things that have happened over the last 3-4 years, not just in uranium, but globally. Obviously, we've had COVID within a supply chain issues, and companies move from just-in-time strategies to building up large inventories. If, as you say, this is fundamentally about supply, demand, economics for the sector. It's such a small sector. So there's a couple of things I'm wondering if they happen is, do companies maintain that building up of inventories to kind of solve their problems? Because they're not quite sure where it's coming from. We've got kind of that whole Russia, China, Kazakhstan thing going on, where you're seeing uranium and enriched uranium like heading east. We've kind of got potentially a bifurcated market where we're talking about USA and allies. It's kind of combative word there, but you know what I mean. Potentially different types of pricing, but potentially a huge shortfall in the West for what they need. You're right. You referenced Diablo there. They've gone out to market and they've gone big because they were running the inventory down. They've had to go big to guarantee the ability to deliver into their market. So do you see sorts of changes of behavior, changes of buying patterns, and this kind of not just restocking but stocking up as potentially being able to kind of, I guess, move the market?
Yeah, look, the power dynamics of pricing is changing. The provider of those services or material is now much more in the driving seat. And it's just, the utilities are struggling to get to grips with that. They've had 12 years of it being their market that they can dictate whatever and whatever they want to do. And now they've got not only uranium producers, primarily Cameco, pushing back on that, but also conversion enrichment services. And, like these, they don't move fast. They never have moved fast. We live in this instant adrenaline hit, social media life now, where if something doesn't happen immediately, you move on because there's a brighter, shiny object that gets your attention. Utilities, they're slow moving. Not only does a fuel buyer have to work out what they need and how they need it and where they're going to get it from, they're then going to take it to their boss and the CEO, and it goes to the board. It goes to a board meeting. The board's not meeting every week. They're running coal and gas and renewables and everything else as well. So, are they coming to recognize it? Yes, they are. There was just a nuclear fuels conference in East Slovenia, I think it was. And people are saying, oh, Urenco, and they're complaining that the utilities aren't willing to come to them on price and enrichment yet. It's like, it's negotiation 101. But the thing that they've proven in the past is if one of the big boys blinks, they all blink. And they know they have to at some stage. They're just trying to work out whether there's going to be another lifeline potentially, like the US government turns around and says, here you go, here's a big check to start some enrichment services, or another tax credit or whatever it's going to be. They're playing the game. And the junior equity investor in the uranium space just is not looking at that. They're saying, all I'm hearing is all this bullish stuff. It should move. And people like you and I can shout from the rooftops, it's happening. But if they can't see it on their e-trading platform, then they don't want to believe it quite yet.
But I think we are a different type of investor. We're not looking at our stocks on a daily basis. We believe in the thematic, so that's why I said it's a creative play, but it's a solid one. But just let's kind of just stick with that. So that question I just asked with regards to how does this kind of play out? Is like I'm trying to because it's kind of like, it's kind of like that during the COVID thing, right? There was a run on toilet roll and pasta. It's like when you think, I'm going to buy this thing now, but if it's not there in a month's time when I need the next toilet roll, pasta, or toothpaste, I'm going to stock up. And people stocked up. And that's the kind of, I wonder what the psychology of the buying behavior for the buyers, that utilities will be. If they feel it's not going to be there when the next time they go to market, do they start stocking up? And what's the, obviously, inflection for the sector, not just in terms of pricing, but in terms of contracting and so forth. That was why I wanted to understand that way. But let's talk about the role of government going forward, okay? Because we've seen in South America chat of nationalization, pick a country, where people want to take control and capture as much of the value as possible. I think the North American imperative is more fundamental than that, is that it's energy security. There's some very combative language out there at the moment, but yet we have failed to see any meaningful input from the government so far. U.S. government, talking about particularly as one of the biggest buyers in the market, one of the biggest consumers in the market, the North American market. So far, not meaningful amounts of money going into the mining component. Industry, yes, nuclear, reactors, extensions, all that good stuff, but mining, not yet. So again, the question I'm asking is, do you see more consolidation where, someone takes advantage of that? Do you see, let's call it participation, not nationalization, of companies in this sector? I mean, again, how does it play out? How does America actually deliver energy security for its population?
Yeah, that's, again...
It's another good question. It's another good question, right?
And again, the uranium is such a small part of what the US is trying to achieve. I don't think they've lost sight of it. And when you speak to those companies that participated in that recent DOE tender for the $70 million or whatever it was, they will all say that there was a lot of paperwork and a lot of hoops they had to jump through to qualify for that program. And you sort of look at it from the Department of Energy's perspective and say, why did you bother? But when you're a bureaucratic organization and you've now cleared that backlog potentially, it means if you want to go big, you don't have to then say, oh, sorry, it's going to be 6 months while we just do your paperwork, Matthew, sorry about that, because it's already done. And that's one of the things some of these US guys are saying now. They're saying, and I'm not investing in them on the basis that the Department of Energy is going to be the sole buyer of the uranium, which is why, as I said, there's a dozen of them telling you they'll produce US pounds, but they all need a $70 DOE price to do so. I'm looking at the ones that can say, I've got, yes, if the DOE want to give me $70 for $1 million or $2 million, fine, I'll sell it to them. But here in the 60s or the high 50s, I've got a market and I can make use of money being an investor. So yeah, as I said, I think that the Department of Energy's now said we've cleared the pipes, and we can do something if we need to or when we need to. Right now, let's focus on the conversion, the enrichment, the HALEU. Let's focus on getting a short list of small modular reactor designs that we can have approved. They're working with the Canadian authorities, for example, and I understand the Europeans to try to have some sort of similarity on approving these designs. Let's focus on that, and then we know we can solve the uranium problem with some money if the market hasn't solved that problem already. Because, I mean, can you get what have the US done in the past? £5 million? Can you get more than that? Sure, maybe, but you have to cut a fair bit of bureaucratic tape around. And it's not necessarily the federal government, right? It's BLM, it's state forest, it's state regulators, there's a whole bunch of things there you need to sort out. Can they look at their partners? And they are. They're seeing that with all their critical minerals, Canada, Australia, turning around saying, well, we'll be the customer for you guys. You do the heavy lifting. So you could find that there's a few US guys that expect the US government to come in and help them, and it doesn't come as quickly as they expect. And other people are reacting to the market and saying, well, we're an ally country. Here you go. Here's $1 million or £2 million a year.
Yeah, it'd be interesting to see how that plays out. I mean, it seems to be moving more positively of late. But yeah, if you're relying on a government to bail you out, good luck on that timing that right. And we better bring it. But sorry, come on.
No, I was just going to say, you look at the French. I mean, the French have loved to be state-owned and all of their stuff. They've lost a lot of uranium supply, and when that was happening, they weren't too worried about it because they were going from 70% to 50%. Now they're staying at 70%, and building more. So they're going to be the ones to watch with respect to government intervention of supply. And whether they've got joint ventures in Canada, are they going to be more aggressive there on their drilling? They've got some opportunities in Africa. Are they going to be more aggressive there to try to sort of find a foothold in that the Chinese aren't going to be fighting for in Africa? So they'll be the interesting ones to watch. But again, they are dealing with their own problems at the moment. Like fighting Germany as to why nuclear should be green. But they'll get there as well.
But don't worry, Guy, it doesn't stop Germany buying energy from France. Right. That was a dig, in case anyone missed it. Right. Let's. There's a great. We're investors. We should bring it back to investing. Okay. Which is, there's a great phrase used over the past sort of 18 months or so, which is, inflation is transitory. No shit. No kidding. Some of that inflation has stayed with us, and some has fallen off, which is great. But it seems, as investors, I'm trying to work out how to look at this moment in time. I say it's come off since beginning of the year. If I look at the peaks and troughs of uranium investing, it's kind of hard. I said at the beginning, hard to know how to read it. Is it a case of, don't worry, the thematic's good, it's economics that is transitory? Hold fast with your views on the uranium thematic. I mean, how do you play? You're managing a lot of money.
Yeah, I mean, it's the interesting thing. I mean, we ran some correlation charts in a few presentations last year when we were looking at uranium moving with other hydrocarbons, primarily sort of gas and coal, for example, because they're all doing the same thing, producing electricity. And you saw obviously this year a lot of those hydrocarbon prices roll back over to a more normal level. You would argue. I mean, people are saying there's further to go downside. I disagree. I'd say it's a slightly higher base than normal, just on the threat of weather, especially in the northern hemisphere for winter. But uranium held in there. It barely budged. So it sort of rode that correlation. It obviously wasn't as dramatic as European gas prices, because that was very specific to what was going on there. But it sort of rode that on the way up, as you'd expect. I mean, maybe people thought it should have done more, but wasn't the mainstream hydrocarbon or energy sort of thesis back then. But when everything rolled off, it stayed rock solid. And yes, the equity came off 20 or 30%, but the actual underlying price stayed. And so when I look at that, and you look back at the 1970s, when I think there was a US investment bank that put out a pretty good report, not really anything new in it, but just they've laid it out well. And they talked about how uranium was sort of counter-cyclical through the 1970s, because there was big reactor build program in response to inflation and energy hydrocarbon issues around oil back then. And uranium, was a good investment because it pushed through that and benefited from that. And I don't see why. Again, you fast forward now, big reactor build program, hydrocarbon and energy problems that haven't gone away. They've just been delayed at the moment. And a primary mine supply deficit that's been seen, of 10 years of inventory drawdown. So I look at that and say, well, the physical market's telling me that things are tight and there's activity going on. The fuel services prices are telling me that there's activity going on. And just because the junior equities are selling off with Bitcoin and tech stocks and everything else, as an investor, yes, that's painful because it's a large part of the investment. portfolio. But I look through that and say, like, great, there's a price that I'm going to be buying almost everything.
Right. It's a bit. Here's the thing. Okay. That. Thanks for that answer. But if you're talking to, I mean, something you referenced earlier with about the fact that generalist funds looking in here, it's way too small. But if you, as a fund manager, need to go and raise some capital, you're going to go and have to talk to some generalists now, because I think those who could buy have bought. Now it's a case of trying to get new money into the sector, right? So if you're talking to these guys who know what they know and probably don't know what they don't know, with regards to the uranium nuclear space, what's the light bulb moment? What's the one thing that you say where they go, oh, I get this. That's the opportunity to make money. Because again, I'm interested as an investor. Oh, that's the way I make money on this. Is there a light bulb moment? So I've met some of them. I'm a bit doubtful of that.
I mean, the hook is that I just point to my performance since inception, where I say I've done 400% net of fee since inception, and they sort of look at you and go, "I'm sorry, you what?" And then you compare the ETFs in that period and say, yes, that's done well. It's done 110%. And here's a basket of sort of larger uranium stocks that have done 100 to 120% as well. So, I'm not running turbo. And what I'm, like the outsized return is not me just, throwing turbocharged darts at everything. When the sector moves, it moves. That's what gets them interested. The next question generally is, what are your top 3 holdings? So for Aussie investors, I'll give them Canadian holdings. And for the Canadian investors, I'll give them Aussie holdings. But my argument then is, this is a concentrated small thesis that's turbocharged, so it's volatile, where, you're going to get 70% of your money back in a few years' time, or 300 or 400% of your money, right? So realistically, a family office of high net worth, what are you putting in? 1 or 2% of your investable sort of pie. I've spent 6 years in the weeds in this thesis, so give it to me. Like, why try to replicate it? It's one of those things, and I think this is a point of discretion we were talking about before. Investors are going, well, I don't really want to lose 30% of my money right now. So, if I've got spare change, as we saw, in the last few years, cryptos goes to $60,000. Guess what? Every crypto handle on Twitter is investing in uranium, because they might not have been pulling their money out, but they go, oh, wow, I've got some money I can play with. Let's go and see if I can replicate that return in uranium. And of course, it all came crashing down on them in a hurry, because they followed each other in. But it's interesting, because you're right. The generalist investor, they get interested in that hook. They will go and do some work at some stage. Sometimes they go, it's too hard. But then when you then frame it around the energy security and the broader thematics of energy transition and blah blah blah, to them that also ticks some boxes that their investors, like there's a whole bunch of superannuation funds down here who do not allow any fund manager to invest in coal, for example. So those fund managers are sitting down here in Australia, for example, small cap funds, saying, in the Small Ords, I've got a bunch of energy exposure, coal is part of that, uranium's now bucketed into that. Can I really afford to be not in at least index weight on that 150 basis points when I already don't have coal? And yes, I know I'm not getting measured on that. So when you start framing it in that perspective, to say it's part of your universe whether you like it or not, and you see it in the US, Russell 2000, things like that. And the turbocharged nature of this means you probably should have something to do here. Then they get that sort of fear of, I don't want to have, miss my benchmark because 200 basis points has gone absolutely ballistic and blown me out of the water. I can explain it if one tech stock goes through the roof, or a lithium stock, I can explain that. But if I miss a sector in my universe, in my index universe, that people have been jumping up and down, it's going to be hard to explain.
Yeah, it's an interesting one at the moment. You've seen people like Parnassus Investments, just changing things up a bit, and now considering investing in nuclear energy. They've been citing, climate change, but, as you say, this energy transition element is a big part of that. They haven't yet committed, though, and it feels like there's a bunch of people like them sitting on the side. And I just wonder, you as a fund manager talking to groups like that, what's the thing that kind of gets them over the line? Because there's a little bit of, look, past performance is no indicator of future performance. So, you've seen a lot of upside here. Is there still upside to be had? What do I need to believe? Or what do you need to tell me that I believe, which says, actually, there's still a bit of upside to go here? Even from retail through to fund managers, they're going to be asking that same question.
Yeah, look, I mean, you look at previous cycles. In the 70s, the spot price appreciated almost 600%. In the 2000s, the spot price appreciated 1,800%. And, it doesn't take too much mathematics to work out that a junior equity is going to be much more leveraged to a spot movement. So there was some phenomenal returns. This time, depending on where you started, if you want to go back to 2017 when uranium was sort of $20, you've seen a 200% increase. If you want to bring it to 2020, when we started sort of moving on, ironically, around the timing of COVID, you've done 135%. So just on the spot price of the raw materials. So you frame it that way to people that say, "Have I missed it?" And you say, "Look, you've missed a little blip off a really, really, really low bottom that has been on a sector that's been completely ignored and on the bones of a bum for 10 years. If that's all you think that's going to happen, and I point people to that Brookfield Renewable deal with Westinghouse. There was a lot of news about Cameco and how they did that. And I continue to say, what people missed was the biggest energy transition investor in renewable projects, 125 gigawatts of projects under development or in production, have basically just given a big green tick to nuclear fuel fabrication, reactor services businesses, and said, this fits. And then when you take that back to Cameco and say, what's been your inbound into your investor relations department? Their answer is people wanting to know about energy security, ESG investors, energy investors as well, and a whole bunch of investors they've never seen ever on an inbound inquiry into Cameco. What's holding them back? I think the rubber stamping in the third quarter of this year, and hopefully Cameco will host a very detailed sell-side analyst briefing where they basically just put the metrics of that deal in front of the analysts, and the analysts go, whoa, wow, this is a lot bigger than we thought. And I think that then the flow through to Brookfield Renewable is the peers in that sector then look at that uplift for Brookfield Renewable and go, whoa, hang on, we're missing this. We need to be looking at what we can do as well, because we can't turn around and say that it's not an investment opportunity in our universe anymore, because the biggest guys just said it is.
Yeah, well, look, it kind of feels like, I don't know, I'm gravitating back to sheep, but take that the right way. Where, I think if one of these guys gets over the line, one of these kind of big funds gets over the line, then perhaps others will follow. They will kind of stop excluding nuclear power and update their prospectuses. I think that'll be really, really interesting if and when that happens. But yeah, if and when that happens, it doesn't necessarily mean they will invest. It means that they could invest if they wanted to, because what this sector needs for sure is new money. The amount of conversations I have to listen to, people droning on about my uranium investment is better than your uranium investment. You need to sell your stuff and buy my stuff. It's like moving pieces around on the same table. What we need is new capital coming in and lots of it. And obviously, I think you do a good job of going around the market and sort of educating fund managers and the like. To finish off, so you feel that sort of general momentum is obviously positive in terms of politicians' change of vocabulary and narrative over the past 18 months, certainly since Russia-Ukraine situation, but also with fund managers, you feel that there's a kind of growing understanding or growing desire to have an understanding of what the opportunity is?
Yeah, I do. It's it's interesting. It's really interesting. I mean, we've seen obviously there's the Sprott physical vehicle for whatever reason draws a lot of eyeballs because it's transparent. You can view it every day, and they update their website. And it's amazing the people that are still sitting out to me and saying, "Oh, that hasn't moved yet." And it's like, but hang on a second, the spot price is up, what 18.5% year to date, and Sprott's barely been in, apart from some, well, sorry, they were in January and February. But in the last month, it's up 8% without Sprott being there. We're what at 57 and change, $57.50, 57.70 today, and probably keep going. And they're not even there. And the number of people who are sitting there saying, "I'm waiting for that to go into the rinse repeat mode of premium to NAV and start hoovering pounds, and then I'm going to get in." I'm saying, look, sure, but it's a really, really small door. And as we've seen in September 21 and then April 22, or March, April 22, when these things, when a very small pool of capital comes in, it really does move it quickly. So it's going to be really interesting to watch that, because I don't think that's far away. You don't have to look too deeply into some of the flows coming out of New York, especially, to see some of these miners being bought. And as we saw in January, the first few weeks, there was increased flow in a few of these names. And then lo and behold, two big hedge fund sales desks in New York suddenly start sending me emails about buying uranium futures on the CME. And they're the biggest buyers in the spot. So, there's a tried and tested fast money model that's working. But it feels this time there's a lot more on the sidelines who are going to be ready for that fast money to take that quick turn and say, you know what, it's moving. I will absorb it. So yeah, it's going to be an interesting one, I think, in the next. Plus, you got seasonality on your. You always get the second half of the year in this sector where the prices start moving and activity starts increasing. Plus, there's a lot of news flow coming from various companies and what have you. That's all sort of been pushed back because of macro or whatever. So it's going to be really interesting to watch, I think, in the next few months, especially.
Well, I agree with you, and I think people are kind of pushing back on news because, down to inflation, which you mentioned earlier, people don't want to put out economic studies because some of those projects obviously don't stack up right now, and they kind of get a lot of things thrown their direction in terms of their ability to actually get into production anytime soon. But don't forget the uranium CEOs, quite frankly, are viewing this thing as well, forget the price today. I always say this, like, if you had a gold CEO talking about, oh, don't worry about gold price today, it's going to double, it'll double, so we'll be fine. If everyone could have that attitude to life, it would be great. But there's got to be a belief that the price moves quickly, whether it's your term contracts, price, and whatever other kind of variations you have on it, will move through 70. Some companies will need it to move through a lot higher than that. This thing works, but it's a massive if moment. And for people kind of looking in and going, well, hang on, why do you guys get to say that? Why is that fair for you and not for all of these other metals, commodities, which also show this huge delta between current supply, global supply, and demand in the next 5 years? So why do they get that free pass?
Because it's the only card that a lot of them have got to use to play, right? And I guess as well, when you've only got one sector buyer that's a handful of long-term thinkers and movers, gold you can go and hedge it if you want to hedge it. You can sign an offtake to send your doré somewhere, and so that there's a market for your product. But yeah, I mean, you're right. But I think it comes down to it's the only thing a lot of these uranium developers are actually able to say, I can't do anything here, but it's going to go up because I can't do anything. So it's whether it works for them or not. As I pointed to, as I briefly alluded to this morning earlier. So if we get to $70 in a hurry, there's going to be a whole bunch of noise around people saying, I'm going to make a final investment decision. And I could probably count on one hand how many of those I'll be backing with some money, because, then you'll get the old, I've got a few permits that I just need to sort out. And, I just need to, I don't have any long lead items and this, that, and the other. And, so I'll be in production. I'll just update my study, and I'll be in production in 2026. So there will be a lot of noise when the price gets there. But again, there'll be 4 or 5 that they'll say, right, when they say they're going to move, I believe they will. And it comes down to, we've been around talking to them for a long time. We were around when no one was picking up the phones of them apart from debt collectors. We've been able to sit there through that journey and really get a feel for who is capable of delivering a project when the price gets there. So it's going to be, as I said, really interesting to watch, because the sector will be a buzz of, plenty of people standing in front of not even a hole saying it's going to be a producing mine in the future. We've seen it before.
It's been great talking to you, Guy. Look, thanks for sharing your views on, I guess, slightly different subjects to perhaps other people are talking about. I think it's been interesting coming at it from a slightly different angle and stop having the same old conversations, because this sector is guilty of that over the past 4 years. So I appreciate your candor and your insight. Thank you very much, Guy.
No worries. It's been fun. Really enjoyed it.